Hello, welcome back to this week's market update. Today is Monday, June 22nd, 2026, and we'll jump right in. A busy week of central bank and geopolitical developments ultimately proved positive for markets. Stocks initially moved lower in the first half of the week following the first Federal Reserve meeting under Chair Warsh, but later recovered as investors reacted favorably to the announcement of an interim U.S.-Iran peace agreement. As of Friday, June 19th, the Nasdaq Composite gained 2.43%, while the S&P 500 gained 0.93%, and the Dow Jones Industrial Average up just over 70 basis points last week. Moving into the week's economic and market news, June's FOMC meeting marked the first under Fed Chair Kevin Warsh and provided investors with an early look at how the central bank may operate under new leadership. As expected, the Fed left rates unchanged at a rate of 3.5 to 3.75%, though the meeting suggested a greater emphasis on inflationary risks as well as institutional reform than many had expected going into the meeting. One of Warsh's first initiatives was the creation of 5 task forces focused on Fed communications, the balance sheet, the use and reliance on existing data, productivity and employment trends, including the impact of AI, as well as the Fed's inflation framework. The move signals an effort to modernize how the central bank evaluates the economy as well as conducts its monetary policy. Institutional change was also visible in the FOMC statement, which you can see here on the screen. It was shortened from more than 300 words in the prior statement to just 130 words now. It became much more straightforward and to the point, including the vote count, as well as the rate decision, and a brief summary of economic conditions. Also, during the press conference, Warsh repeatedly referenced price stability throughout the meeting, and that's also what contributed to some of Wednesday's sell-off last week, signaling that inflation remains a central focus of monetary policy, and we'll see how that fed into the SEP, the updated quarterly summary of economic projections, in the next slide. Looking at the updated summary of economic projections also released at the Fed meeting, we can see several changes from the prior projection in March. So first, you can see GDP growth was unfortunately revised slightly lower there. However, on the positive, the unemployment rate expectations was revised slightly lower, so that's a bullish sign there. Inflation was moved up quite significantly on both headline and core expectations. And then last but not least, a pretty significant change here. The Fed itself is now pricing in 1 rate hike by the end of the year. So currently rates are at a range of 3.5 to 3.75%. If the median Fed funds rate projection is at 3.8%, that suggests that there is a fair probability of a rate hike moving forward into year end. Also notable here, you can see the expectation for interest rates going into year end of next year, 2027. That was also revised upward, and the same for 2028. We'll take a look at how the market is pricing in these changes in projections in the next slide. Following the Fed meeting and updated summary of economic projections, interest rate expectations in futures markets shifted in a more restrictive direction as well. Over the past week, market pricing moved from a base case to 0 to 1 25 basis point rate hikes to now being a base case of 1 to 2 25 basis point rate hikes before year end. Current pricing suggests that the first 25 basis point rate hike could occur as early as September, with another potentially following in December. The shift follows an updated SEP that raised inflation forecasts, as we just saw, and it also showed a median Fed funds rate expectation of 3.8%, suggesting that policymakers now see a strong possibility of tightening in the second half of the year. Also contributing to these changes in market pricing, Chair Warsh's repeated emphasis on price stability throughout the meeting reinforced this shift in expectations, signaling that the Fed remains focused on inflationary risks amid a stable backdrop of labor market conditions and economic expansion. Continuing on in our other economic data, retail sales came in stronger than expected in May, rising 0.9% during the month and up 6.9% from a year ago. Gas station sales were the largest contributors to growth, up 26.5% from a year ago, as elevated energy prices continued to impact consumer spending patterns. Outside of energy-related spending, several categories also showed solid growth. Electronics and appliance stores saw sales rise 6.3% from a year ago. Sporting goods and hobby stores increased 11.3% year over year, and non-store retailers, which is primarily online shopping, was up more than 12% from a year ago. Some categories were softer, however, with restaurant and dining sales rising just 2.7% year over year, a rate that has been cooling, and declining 0.1% during the month. Overall, though, the report suggests consumer spending remained solid in May despite the higher energy costs and inflationary pressures. Last but not least, the Conference Board's leading economic index rose 0.1% in May, marking its second consecutive monthly increase following a small gain in April. The improvement was driven almost entirely by financial components, with stock prices as well as the interest rate spread contributing to the increase, while other categories were negative. So looking at those, we had average expectations for business conditions continues to be a pretty heavy drag, actually the heaviest drag over the past 6 months in terms of the non-financial components, as well as a slight drag from an increase in average weekly initial claims that we took a look at in previous weeks, although that remains in a fairly healthy range. It's just come up a little bit in the past few weeks. Although the LEI's underlying components remain mixed, the index has remained out of recessionary territory for more than a year now, suggesting a relatively neutral economic outlook based on the index on its own. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon.